PNB Housing Finance that we're focusing in on. And joining me in studio to speak to the management is Harsh Saita. Harsh, you've seen the numbers. What stood out to you?
Well, the operating profit has come in much better than anticipated. So that's the one beat that's come through. Also, you've got reversals in terms of, or rather recoveries, aiding that credit cost number, which is actually negative. So thereby impacting profitability positively. But it was anticipated. And Girish Kousgi joining us at this hour, MD CEO at PNB Housing. Welcome, sir. Thanks for waiting by so patiently. Let me first start off by understanding the outlook. It's a rate cut cycle and a sharp one. What does that do to your margins? What's the outlook like for FY26 in particular? And then thereafter, where does it stabilize at?
Good morning, Harsh.
Good morning, sir.
It was a good quarter. And as far as NIMs are concerned, it will be stable. I had earlier guided between 3.6 to 3.65. Now I'm upping the guidance to around 3.7%. So this year we'll be able to maintain at about 3.7% NIM. And going forward, it should inch up.
From there on, so that inch up should likely offset any credit costs coming your way. I remember you suggesting that. Sir, the recoveries are stronger than expected.
Yeah, I think given quarter one, which generally is mild, and muted, so we had good recoveries, and that really helped. And after this year, maybe for a quarter or two in next financial year, we'll have some support from the recovery. After that, credit cost would be 25 bips. So with our focus on shift in segment and also trying to increase yield in each of these segments should help us to NIMs to inch up going forward. That is after this year. This year it will be 3.7%. From next year it will start inching up.
Got it. So this 5 to 10 basis point increase in margin, does that in any way materially change the ROA that you're targeting?
See, today we are at about more than 2.5%. We are at 2.57 this quarter. So what will happen is once the support from recovery ends and shift in segment, more skewness towards affordable and emerging, which are high margin business, will ensure that the yields will go up, margins will increase, recoveries will go off, and therefore the actual credit cost kicks in, which is about 25 bips. So we should be, in the bracket of 2.5 to 2.6% ROE.
Got it. If I were to probably take a sidestep here, there was a very large private sector bank which spoke about how there is pricing pressure in the housing finance segment because of likely competition and the way competition is behaving. Are you seeing that, sir? And is there an impact of that on both your growth as well as likely on your yields? I don't see that on your margins clearly, but likely on your yields. Just give us a color on that.
So if you look at quarter one being cyclical, in addition to that, because of repo cut of 100 bips in last 6 months, there was a lot of challenge on pricing, which is why if you look at a prime growth on disbursement, it is flat, whereas affordable has grown by 30% and emerging 32%. If you look at the book growth, prime is the lowest, which is at 10%, emerging is 20% book growth, and affordable is 143% book growth. So because there was a bit of challenge on the prime book, we didn't want to do business at the cost of margin, and therefore consciously we didn't grow our prime book, and we focused more on affordable and emerging. And we had guided 18% growth rate for this year, and we are at 18.1. So very easy we'll be able to achieve. So this won't impact the growth or the margin. Yields, yes, it might impact, but when the yield go down, even the cost of borrowing will go down. So we are very clear on the margin. We will be very clear on the margin as to what is the margin that we want for this year and next year. And accordingly, we will try to moderate the yield, because cost of borrowing depends on how the transmission would happen from banks and various from various other instruments. So we are very clear on margin. So because of this repo rate cut, it won't impact our margins or the growth. Yield, it might, but that will also get offset because of the cost of borrowing go down, even though with a lag of 3 to 4 months time.
So, sir, firstly, you're acknowledging that there is this competitive pressure coming in more from a pricing standpoint than anything else. You're also acknowledging the fact that you might stay away from prime loans. Is this going to be a Q1 phenomena or a H1 phenomena, or do you expect this to continue all through FY26? Give us color on that. And what does it therefore do to your book overall? Does it mean that you're going away from prime would likely mean an inch up in credit cost at all, if you're anticipating that?
No, actually, this was the plan not now. Since last over 2 years, we've been slowing down a pace on prime, and this strategy would continue because our focus is on emerging and affordable and grow the prime book at a slower pace. And this started 2 years back, not now. So this strategy would continue. Our retail book reaching 1 lakh crore by March 27 is intact. Our margins are intact. So it will not impact anything because all these things are baked in.
Okay. Thank you so much, Mr. Kousgi, for coming in, giving us a candid color on everything that's happening in Q1. But with that, back to you, Alex Mahima.
Right, so interesting conversation, Harsh, for sure.
Yes.
Quick view, Swati, on the charts for PNB Housing, and this I'll club with a question that Vaishnav here has. He wants to invest around 1 lakh rupees for the next 3 odd months in the BFSI space. Which stock would you recommend?
Yes, PNB really looks very good and promising on the weekly chart. As of now, we are witnessing a consolidation phase from the last 2 months. Any momentums above 1120 will take down a counter towards to at least 1200 to 1250 levels. So my view is definitely positive. One can go for a long positions at least 20-30% at the current market price, and if you're getting any dips towards 2020, 1030, one can definitely add on. So the chart looks promising. One should definitely hold their long positions or can generate the long positions at the current market price as well.
Okay, so all right, the next question we're taking is on